Good day, investors. In this video, we will take a closer look at Suncor, ticker symbol SU. This is a company that is becoming a much more stable, cash-generating machine, supported by improving operations, a stronger balance sheet, and a very compelling outlook going forward. So in this video, we'll break down the core business and fundamentals, then go over some key financials, and finally, look at the valuation. And at the end, I'll give you my personal take on why I think Suncor could be a strong addition to a long-term portfolio. But before we get into it, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. Thank you very much. So first, let's take a quick look at what the company actually does. Suncor is a fully integrated energy company. It produces oil from oil sands, refines it into fuels like gasoline and diesel, and then sells those products through its own network. So it controls the entire process from production to final sale, which makes the business more stable than a typical oil producer. And if we take a look here, you can clearly see how the whole system is connected. And at scale, this is a very large business, with around 855,000 barrels per day of production, about 466,000 barrels of refining capacity, and over 610,000 barrels per day of product sales, making this a large, well-diversified energy system. Now, if we start by looking at Suncor's competitive position, what really stands out is how much the company has improved in terms of its break-even oil price. Back in 2023, Suncor was sitting much higher on the cost curve, but today it has moved significantly lower, closer to the more competitive range. And that's very important, because a lower break-even means higher margins and stronger cash flow. So overall, we can clearly see a strong improving trend in Suncor's cost structure. And this trend has clearly translated into stronger financial performance. As we can see here, Suncor has reduced its break-even from around $53 per barrel in 2023 to about $43 today. At the same time, free funds flow has increased significantly, growing by over 65%, or more than $3.3 billion. And that's a very strong improvement, which supports higher margins and strengthens the company's overall profitability. And when we look at the outlook, we can see that management is planning to improve efficiency even further. The company is targeting an additional $5 per barrel reduction in break-even, bringing it down to roughly the high 30s by 2028. At the same time, free funds flow is expected to increase by another $2 billion, indicating even higher margins going forward. And these estimates assume an oil price of around $65 per barrel. So if oil prices continue to rise, that would provide additional upside to cash flow and overall profitability. So when evaluating how the company can improve those efficiencies, this slide highlights a key advantage. Suncor's operations are highly geographically concentrated, with most of its assets located in the same region. And that creates clear benefits, because it allows for shared infrastructure, lower costs, and more efficient operations. And the resource base in that region is also very large and long-lasting, with over 30 billion barrels of resources, providing strong, long-term production visibility. And when looking at the company's resource base, we can see that not only is the asset base large, but it is also of very high quality. The company has a strong in-situ portfolio, meaning it produces oil directly underground using wells, rather than mining it. With major assets like Firebag and Lewis, each representing around 9 billion barrels. And when we look at the right side, we can see that these assets also have strong pay thickness, which is a key factor for efficient and low-cost production, further supporting the company's long-term outlook and future profitability. Now, when we look at the Firebag asset, this is one of Suncor's most important growth drivers. Firebag has already produced over 1 billion barrels, and the company is now planning to expand it significantly. The project targets an increase in production capacity while leveraging existing infrastructure, which helps keep costs relatively low. So scaling production here will be a key driver of future growth and cash flow. And the Lewis asset is another important growth driver. What stands out here is that it also leverages existing infrastructure, which means no major new processing facilities are required. At the same time, The project is expected to produce up to 160,000 barrels per day, with a resource life of over 30 years. So similar to Firebag, Lewis represents a low-cost, long-life growth opportunity for Suncor as well. Now, after looking at the growth projects and cost structure, what does this mean for investors? And it really comes down to cash flow. As we can see here, Suncor is projected to generate around $40 billion in cumulative cash flow over the next 3 years, assuming oil prices of about $65 per barrel. And if oil prices are higher, that number could increase to around $50 billion. At the same time, cash flow per share is also expected to grow strongly, at around 11% annually, driven by both operational improvements and ongoing share buybacks. And when we take it one step further, we look at free funds flow, which is what's actually available to return to shareholders. As we can see here, Suncor is expected to generate around $22 billion in cumulative free funds flow over the next 3 years, assuming oil prices of about $65 per barrel. At the same time, total free funds flow is growing at around 10% annually, and on a per-share basis, free funds flow per share is growing even faster, at around 15% annually. And that's especially important for investors because it means more value being returned per share over time. And when we look at the current balance sheet, we can see that Suncor is in a very strong financial position. The company has an investment-grade credit rating with a long average debt maturity of around 12 years, which reduces refinancing risk. At the same time, liquidity is solid at around $9 billion, giving the company plenty of financial flexibility. And importantly, net debt is very low, at around 0.5 times cash flow, which means the balance sheet is not only stable, but also well-positioned to support future growth and shareholder returns. So when looking at the returns going forward, Suncor is expected to return a significant amount of cash to shareholders. As we can see here, total cash returns could reach around $23 billion over the next 3 years, and even higher if oil prices increase. A key part of this is the dividend. The company is focused on paying a reliable and growing dividend, supported by strong and stable cash flow. At the same time, additional returns come from share buybacks, which further increase value on a per-share basis, making this very attractive for long-term investors. And now when we look at the dividend data from stock analysis, Suncor currently pays an annual dividend of around $1.70 per share, with a yield of roughly 2.6%. The dividend is paid quarterly, and importantly, the payout ratio is around 48%, which means the dividend is well covered by earnings and cash flow. So overall, this is a safe and growing dividend, with room for further increases over time. And when we look at the analyst ratings from stock analysis, the stock currently has a strong buy consensus rating. The average price target is around $74, which implies roughly 12% upside from current levels. And the highest price target is about $75, indicating a potential upside of around 13%. Now, when looking at the stock performance, we can see the current setup more clearly. The stock is currently trading at around $66 per share, giving it a market cap of roughly $78 billion. At the same time, the stock is trading close to its 52-week high, which shows strong recent performance. The stock is up almost 60% over the past 6 months, indicating strong momentum in the share price. So when we step back and look at the bigger picture, Suncor today is a much stronger and more efficient company. We're seeing stronger operations, lower break-even costs, a stronger balance sheet with lower debt, and more disciplined capital allocation. At the same time, operating expenses have remained stable despite higher production, and the business is built on low-decline oil sands assets, which gives around 5% decline rates and very long life reserves. Combined with strong North American infrastructure, this creates a very stable and predictable cash flow profile, with geographic concentration driving operational synergies and cost advantages. Looking at the financials, the company is generating strong free cash flow, which supports both dividends and share buybacks. So in my opinion, this is not a high-growth stock, but a high-quality, cash-generating energy company. And for dividend-focused investors, this offers a combination of stability income, and moderate upside potential. And even at current valuation, the stock still offers some upside, especially if oil prices remain supportive. If you found this video helpful, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. And as always, remember to do your own due diligence before making any investment decisions. Thank you for watching and happy investing.